Hello, this is Mark Santero, CEO and President of the Homestead Funds. I want to thank everybody for jumping and listening to our first quarter market review. First and foremost, before we get started, I hope everyone is safe and well and then are dealing with the pandemic. I want everyone to know that the Homestead Funds is operating smoothly and we are working remotely but with no interruptions to our service and support. So without further ado, I'd like to talk to everyone about our agenda, and then I'm going to turn it over to our two portfolio managers who will be speaking today, Mauricio, our Senior Fixed Income Portfolio Manager, and Prabha, our Senior Equity Portfolio Manager. What we'd like to cover today is our macroeconomic conditions and factors, the fund's absolute and relative performance, those funds' drivers of return, and then what I think everybody wants to hear is our outlook and fund positioning as we're now into the second quarter. So without further ado, I'm going to turn it over to Prabha to give a brief update on the first quarter and the shocks to the equity markets. Prabha?
Thank you, Mark. I echo Mark's sentiments. We hope you are all doing well. As we all know, the global pandemic, COVID-19, has brought to a halt an almost 11-year rally in the stock market. The U.S. Federal Reserve and other central banks have implemented policy initiatives on the monetary policy front. And the U.S. Congress, U.S. leaders, and global leaders have implemented fiscal initiatives on the spending front. The equity markets have bounced back from the March 23rd lows. We are down, but we have recovered some of our losses. We are awaiting news on the healthcare front, the therapeutic and vaccine fronts, and we are hoping for a gradual return to normalcy. So now I'll turn it over to my colleague Mauricio for fixed income thoughts.
Thank you, Prabha. As you mentioned, the Fed stepped in during the quarter, and they cut rates during two emergency sessions. The first cut 50 basis points, the second cut 100 basis points in March, driving rates all the way down to zero. More importantly, the Fed brought back facilities that were put in place during 2008, and they also added the purchasing of corporate bonds to support the credit market. We will now go into the performance review for the first quarter for the short-term bond. During the quarter, the fund posted a positive 1.27% absolute return, trailing the benchmark by 68 basis points. What didn't work for the fund in this quarter, our long-term positioning in ABS detracted from performance, and also our positioning in industrials, particularly the energy sector, the pipelines. What worked for the quarter, the duration component of the fund and our exposure to treasuries that we had ramped up during 2019. Now, taking a look at the composition of the portfolio for the quarter, the duration remains fairly close to the benchmark, and we took advantage during the quarter to add more corporates. Looking into the intermediate bond fund performance, the situation is very similar versus the short-term bond for the quarter. We trailed the benchmark by 97 basis points. The asset-backed sector also detracted from performance for this fund, and also the agency sector where we hold an underweight allocation. What worked for the intermediate bond fund? Our exposure to agency mortgage-backed securities, particularly the 3.0 and the 3.5 coupon stack at a time when the Fed stepped in with quantitative easing to support the mortgage-backed security market. And with that, the portfolio snapshot for the quarter, the duration is fairly close to the benchmark. Although at this level of rates, we feel that it's not as punitive going forward, the duration component of the portfolio relative to the benchmark.
Great, thank you, Mauricio. Now I would like Prabha to talk about our two equity portfolios that we manage, first with the value fund. Prabha?
Thank you, Mark. The next slide shows the performance review of the value fund. The Homestead Value Fund, as you can see from this slide, has outperformed in every performance period listed versus the Russell 1000 value benchmark. In a very competitive space like large cap, we are indeed proud of our record. What worked? The next slide will show you some of the performers and detractors. What worked for value fund in the quarter and over the long haul, it's been the overweight position in information technology and healthcare. Information technology in general has been one of the best performing and most defensive sectors year to date as of quarter end. And some of the names you can see in the top 10 holdings, Microsoft, it's representative of the type of companies in this space. They're high quality businesses with strong returns on invested capital. Microsoft is strong in Azure enterprise cloud computing and Office 365. Gross margins reached a 6-year high, leading to EPS growth of 37% year over year, and it has a fortress balance sheet. Another top performer in infotech for the period was NVIDIA. The stock has been up double digits year to date with the benchmarks down, and the company's data center and gaming graphics chips have buoyed results. In the healthcare space, Abbott, a long-term holding, has contributed to results. Healthcare has been a historical overweight. It's been ballast to the portfolio, and it's a combination of defensive and growth characteristics. Abbott, with its initiatives on COVID testing, it's at the vanguard of improving living conditions for all. What didn't work in the period were consumer staples, which underperformed. At the bottom of the same page, you see the valuation metrics, and I would point out the return on equity on the portfolio is 21.1% versus the Russell 1000 Value Index at 14.6%. Return on equity shows how profitable a company is for the shareholder, and these are very attractive numbers. Now I'll go to Homestead Small Company Fund. And the performance page is this slide. As you can see, we outperformed the benchmark, the Russell 2000, for the quarter, for the 1-year period, and since inception. Infotech and healthcare sectors also led performance in this fund. And on the next slide, you can see the top holdings. Mantech has been a long-term holding, a beneficiary of government IT outsourcing and growth. Five9 in the cloud-based contact center software setting has had strong demand with everyone working remotely. It's a big addressable market, and earnings have been compounding at double-digit rates. LHC, a healthcare provider with high star ratings for high-quality care, has also been a good performer during the period. And I would again point out at the bottom part, the return on equity for the fund is substantially higher than that of the Russell 2000. Detractors in this portfolio were some industrials and materials. Now I'll turn it back over to Mark.
Thank you, Prabha. Thank you, Mauricio. As I said, I think where we were at the lows in the market on March 23rd for the equity market and all of the dislocations in credit those first 2 weeks, it was a tale of two quarters, literally within a quarter. The January and February, great performance. mid-March, the roof caved in. So what's ahead now that we're almost at the end of April and we've seen some market recovery? I'd like to turn it back over to Prabha and Mauricio to talk about what we see going forward. And Prabha, I think you have the first slide.
I do. Thank you, Mark. I appreciate it. So though we have faced and are facing a period of volatility and uncertainty over the near term, active management should outperform during these type of periods. And this first slide shows active managers through a full market cycle. This data is from Morningstar and Barron Capital. Active managers through a full cycle includes the bull phase, the bear phase, and the full phase. And the bar charts in the middle, I call it the mustard brown. Others may have a different descriptive. Mm-hmm. But it shows stronger performance during bear markets. This is evident with the spike in those charts. And our performance reflects this experience. And the next slide shows that a part of the same study. It revealed that in the large cap category, that top performing active managers have delivered positive returns over the full market cycle. And top performing is defined as managers who ranked in the top half of all large cap managers at least 60% of the time, based on 3-year rolling monthly returns. It's a testimony to our efforts, process, skill, and experience. And now I'll turn it back to Mauricio.
Yes, Prabha, as you mentioned, this is the time for active management to shine, and we are fairly confident in our process both on the equity and on the fixed income side. This is a chart that we displayed during the prior review for the fourth quarter of 2019. As we see here, the credit spreads during the quarter, as Mark mentioned, it was a tale of two halves. I mean, the second part of the quarter, we saw massive spread widening. Investors were concerned about the effect that the COVID-19 crisis and the stress that it would put into corporations, and an event that basically, came out of nowhere. As we see here, credit spreads widened to levels not seen in the past 30 years, excluding the financial crisis. I would point out here that the velocity of the spread widening was very fierce. It lasted, all of about 3 weeks or so. And the Fed and on the fiscal side, we've learned from 2008 in particularly. The Fed reacted in a quickly manner to bring back facilities used in 2008, and more importantly, they put in place facilities to support the credit market, including purchases of corporate bonds. And what do we do in this regard, and how are we positioned looking ahead? The team during the quarter took advantage of this dislocation in credit to deploy some of the treasuries into front-end high-quality corporates when the spreads were near the widest levels, and once we had full certainty that the Fed would provide a lifeline to the marketplace. And as such, we are now holding an overweight position in both industrial and financial sectors for the short-term bond fund and as well for the intermediate bond fund portfolios. And I'll pass it along to you now, Mark.
So that concludes our first quarter market review, and hopefully it's given you a little bit food for thought going into now the second quarter and what we might expect. Although markets have stabilized. They continue to be volatile, as Prabha pointed out, until we have some type of clarity on the duration of the pandemic, a vaccine or therapeutics in sight to mitigate the damages that the virus causes on individuals. The markets will, in our opinion, continue to be somewhat volatile. We are here to support your investments. Our people are on the phones. You can email me, you can call me if you have any questions on the presentation or on your individual holdings in the Homestead funds. We want to thank you again, and we hope that you remain safe and well. Thank you very much.